might as well just get going. Thank you very much for taking the time to just consider your financial statements and how you might use them just to really oversee your business. I love financial statements. I'm a little introduction about myself. So I'm a CPA and accredited business evaluator. I've been with the Williams Group for just over 20 years now. It's a long time. So I consider myself being in your profession, the eye care profession, for 20 years. So I know a fair bit about it, not necessarily from the professional standpoint, from a physician point of view, obviously, but from a business point of view, I'm pretty familiar with your profession. And it's a wonderful profession to work in, or work for, I should say. So a little plug about us, I guess. So we have the Williams Group. If you don't know, we have 3 divisions. Just real quick, we have a bookkeeping, accounting, and tax division. That's one of the 3 in the newest of the 3. We've been doing accounting and bookkeeping and tax work for our clients for I'd say 8 years or so, 7 or 8 years. And then we have a consulting business also. That was our original business, started by Dr. Brad Williams over 30 years ago. And then so that's now run by Robin Elliott. She's the president of the consulting division. And the financial statements are really helpful for the consulting side, because if they're presented like I'm going to show you today, it's much easier for them to consult on a financial basis. And then the 3rd division is transitions, so appraisals, valuations, and helping doctors sell their practices or bring on partners. So that's runs the gamut of what the Williams Group does. Bill Nolden runs that. And Bill's been around with the Williams Group for not quite the whole 30 years that the company's been in existence, but pretty close. And then Archie Keebler, he's also CPA. He runs our tax practice. And then Patrick Reynolds runs the accounting and bookkeeping and reporting end of our business. So if you need help with any of those 3 things, that's my little plug for the Williams Group. So I'm keeping everything up on my screen here because I'm going to toggle back and forth between a few different things. It should just be easier than showing the PowerPoint presentation. All right, here's the agenda. So we're going to talk just real briefly about the different types of P&Ls, profit and loss statements. I always like what Dr. Brad Williams, I mentioned, our founder, he would always say there's different ways to skin a cat. I don't know about skinning cats, but similar with profit and loss statements. There's different ways to present profit and loss statements. There's not just one way in accounting to present profit and loss statements. So we'll go through the 4 major types of profit and loss statements really briefly though. And then we're going to talk about the categories, the profit and loss categories that I think are ideal for optometric practices, for OD practices. And I'll explain why. And then we'll briefly talk about operating net in optometry. And there's a unique operating net in optometry. And then EBITDA. So earnings before income or interest, earnings before interest, taxes, depreciation, and amortization. It's a bit of a mouthful. But really what it is, EBITDA is just simply your operating cash flow except for interest and depreciation and amortization are really capital costs, i.e. your equipment and anything that is not germane to the actual operations. Your equipment is, but that's a capital expenditure. It's not a current operating expenditure. So most businesses, private equity, or if you're going to analyze a business, you typically look at the operations, and then you look at your equipment expenditures, leaseholds, and everything else that are necessary to run the business. You look at those things differently. I'll get into this just real brief. So the reason why that is because some businesses, and same with some optometrists, they're going to have a different capital expenditure profile. So some doctors are going to spend a boatload of money on their equipment, and so that's one profile, capital expenditure, whereas some other ODs might not be investing as much in equipment. So you have to sort of look at that separately. How are their operations doing outside of or separate from the capital expenditures that you're investing into the equipment or investing into your business to run your operations? So it's an important distinction. I might talk a little bit about that, but we'll leave that at that for the moment. And then a little bonus. It's an interesting way to characterize it, a bonus of benefits of QuickBooks Online. So we can talk about that, and then we'll have a brief Q&A, like I said. So, all right, so let's talk about the types of profit and loss statements or the types of financial statements. Okay, so there's four, like I said, you can see them here: GAAP statements, cash-based statements, internal revenue code or tax basis, and then managerial. So GAAP, I'm going to show you an example of GAAP-based financial statements. And typically GAAP statements are only done for public companies. And I chuckle once in a while because you'll see, if you have loans, say a practice finance loan, one of the covenants will be that your financial statements are required to be presented in GAAP basis. Well, I chuckle with that because I think some of the bankers don't really understand what GAAP is. So I'm going to just really quickly show you Amazon's financial statements, and these are GAAP-based financial statements. And you're not going to be able to see too much because the font's small, but I'll just toggle over to them. So Form 10K, that's the annual financial statements that are the GAAP-based that are presented or that are required to be filed with the SEC. So some preliminary stuff. So you can see here's the index of GAAP-based financial statements. That's 75 pages long. So GAAP requires preliminary information about the business, the risk factors of the business, any legal proceedings. So these are all just disclosures, safety disclosures, management discussion and analysis. So this is GAAP. So it's if you can present these to your banker and they actually require this, well, it's going to cost you a fortune because it just doesn't get done. And then you can see the financial statements start on line or page 33 and go through all the way to page 69 because there's all these different disclosures. So I'll just bounce over real quick to show you these Amazon financial statements. So page one, just here's the audit report, blah, blah, it's by Ernst & Young. And they sort of present them in the opposite order that's traditional. The order isn't important, but cash flow statement, statement of operations, which is really the profit and loss statement, and the balance sheet. So let me just go over to the statement of operations. So 2020, this is small, but don't worry about it. So these are presented well, and we present our financial statements like this too, because you can see the operating income, and we're going to talk about operating income, and that's a really important number. So when I see financial statements from that, a lot of times from clinics that we're picking up or books that we're picking up, you don't know what your operating income is because there's just simply a long laundry list of expenses. And like I said, we'll talk briefly about this importance of operating income. So ours are similar in that we present to you guys or ODs: gross sales, cost of sales, and then sales and marketing, G&A, operating, etc. So that's the presentation at a high level. So 2020, Amazon did 386 billion, and then 2022 they did 513 billion. So yeah, pretty big company. And then their net income actually lost money in 2022 because I think they grew so much. They grew so much. But so I'll just run through this super quick. Here's the balance sheet. They've got 36 billion in cash, 420 billion total assets. And then scrolling down here really quick. So they have to have the description of the business and then the principles of consolidation, etc. Because obviously Amazon's not one company. They probably have 500 different companies all over the world that they consolidate into those financial statements that I just that I just showed you. This is more for interest's sake. So I'm going to go down to page 66. Again, this is more for just kind of, which I find kind of interesting. So there's all these disclosures that are required. So you can't just get GAAP financial statements. You don't just go, here's my balance sheet, here's my income statement. No, there's all the related disclosures about the property and equipment, the leases, all your commitments, etc. So these are GAAP. So let me just quickly go down to page 66. I was showing Brittany this earlier. We were talking about it just on Amazon's. So yeah, we're still going on these financial statements. So these are GAAP because disclosures are required. So one of the disclosures for GAAP-based financial statements are your segments. So in our business, like I was saying, in optometry, it would be similar that you've got two different segments. Typically, you've got your professional segment, and then you have your optical or retail segment. So if you did provide GAAP-based financial statements, typically you would have to separate those two out. So I'm still scrolling down here. I want to get to page 66. Okay. So with Amazon, so they segment their information into 3 different areas: North America sales, international sales, and then Amazon Web Services. So their North American sales, we'll go to 2022. So they did $315 billion in North America, and they lost $2 billion. International sales, they made a bit of money in 2020, and then in international sales, they did $118 billion, and they lost $7 billion. I think just kind of because of growth, and I think they had some write-offs in 2022 also. And then the big moneymaker is not their delivery system where they're dropping stuff off. This is where they make their money on Amazon Web Services. So they did $315 billion in North American sales in their sort of retail business, I guess I'll call it. But their web business, they did 80 billion and then made 22 billion. So they basically make a good chunk of their money from this this segment. So it's kind of useful, and it is difficult in healthcare and optometry to really put your 2 activities to really see, okay, what are you making money or losing money on optical? Are you making money or losing money on in the professional side of it? So point is, those are GAAP statements. So I'll just leave it at that. So real quick, GAAP is accrual. So accrual really simply means that you recognize your revenue when the agreement has been made or the work has been done, not when the cash comes in. So that's how you recognize revenue under accrual, and then same with your expenses under accrual. You don't put the expenses on the financial statements when you kick out the cash. You put the expenses on the financial statements when you incur the expense. So you owe the money, you bring in frames or lenses, but you haven't paid it. So that's accrual. Whereas cash basis is simple. You recognize the income when the cash comes in, and you recognize the expenses when the cash goes out the door. So that's cash basis, pretty simple. But so I'll leave it at that. And then the Internal Revenue Code, IRS, is tax basis. So tax-based financial statements, again, are different in that you recognize the revenue based on when the Internal Revenue Code or the IRS wants to tax it, and then you recognize the deductions or expenses when you're allowed to deduct them. So that's tax-based financial statements. So I will say, just as a bit of commentary before we get into optometry-based managerial financial statements, is that a lot of tax preparers, they want your financial statements, they want them in tax basis because it's easier to file the tax return. But that's not necessarily the best way to and I don't think it is at all, to present your financial statements to you, because you want to see what's happening in your business. That's what's important to you. The Internal Revenue Code, okay, we can adjust your financial statements for tax purposes, or we can adjust them for cash, or we can adjust them for GAAP. But almost always with internal financial statements, You want them to be for you, the owner, the manager. Present them so you can understand how your business is run and the nuances of your business. So for example, I'll just bring up this. This is a 1120S tax return. I'll just prove that it's the tax return. I'll show you the top of it. So this is the 1120S. So most of you, or a lot of you, have S Corp returns. Okay, so the Internal Revenue Code, the IRS, they recognize this. But some tax preparers, they still want everything in tax basis. But the M1 is a reconciliation of income per books with the tax return. So net income per books. Then you start adding back any revenue or deducting any expenses that are on your internal financial statements, so that you can file the tax return. That's what this Schedule M1 is for. So you don't necessarily have to have your financial statements in your internal financial statements in tax basis, because they provide this form and that's how you do it. So that's an introductory on the three other types of main financial statements. Okay, so managerial. Again, accountants ought to present, and we make an effort to do this, and I'll show you this in a second, to present your financial statements, your operations, in a way that you can understand how your business is doing. So that's what managerial financial statements are. So let me just show you. I'm going to toggle over to, I don't think I thought I had it up here. I'll just go back to QuickBooks Online. It'll be good just so you can see how QuickBooks Online functions if you don't have it. So I'm going to log in. I thought I had it all up, but I must have closed it. But that's, let me just see, maybe it's in a different tab. Nope. So that's right. So these are, I'm just going to go to my apps, and you probably can't see this because it's small. And I'm just going to toggle the QuickBooks Online. And so I'm going to take this to a different screen just because I don't want anybody else's information. We've got sample financial statements, so I'll just bring those up. So I don't want anyone else's. All our clients are all in one big list. So give me 2 seconds here. Bring them up. All right, that should do it. I'll bring it back over. So I'm just going to go over to reports. And then I have these saved for P&L comparative webinar. So these are the webinar financial statements. And then I'll make this bigger. Let's make it 200. That should do it. Nice and big. So we're going to talk about these three things here. Back over to the PowerPoint. The financial statement category is number one. And then the operating net and the importance of your operating net and what that is, and then EBITDA. And then we'll talk about QuickBooks Online. We'll kind of do QuickBooks Online right now because you can kind of just see what this is. So I'm just going to go down this really fast just so you can see that there's a bunch of detail here. So under cost of goods sold, we've got contact lenses, consolidated buying group. This should really get split out between whatever the consolidated buying group is doing. If you have a consolidated buying group that you're getting your cost of goods sold from, frames, lab costs. So this is just all the categories. So point being, we have subcategories underneath the main 5 categories. And I'll talk about those 5 in a second. So human resource costs, and then marketing, occupancy, so rent, property taxes, blah, blah, then overhead, that's another section. And then separate operating income, or excuse me, other income. So here's your net operating income here. I'm blowing through this pretty quick, but we'll get back up to the top, and then everything below this net operating income. We've got other income, capital costs, debt service, associate doctor compensation. So we have a few categories under that, and then a few categories under doctor owner compensation, et cetera, and then non-operating, which is essentially discretionary. So I'm going to collapse this. I'll go right at the top, and I'm going to collapse this down so that you're only going to see the big categories. So cost of goods sold, there we go. Okay. So I'm going to talk about these just real briefly. So these are the main categories to be able to see what your net operating income. I'm going to make this one click smaller because it's just, hopefully you guys can see this. Income's pretty straightforward, just the cash coming in, that's the income. And then cost of goods sold. So the nice thing here about these is you can see what your percentage is. So there's benchmarks within optometry. So it's obviously important not to have, say, your frames just on and your lenses or ophthalmic lenses, your contact lenses kind of scattered all over the place. You want to have them in one section under cost of goods sold so that you can see what your total percentage is. So if you're up into 40%, that's getting real high on your cost of goods sold. So there might be something you need to do about that. Or if you're down the 20% range, that's good. That might mean you're doing more medical, but cost, like I said, cost of goods sold is a difficult issue in optometry because you're not necessarily comparing apples to apples and oranges to oranges, or taking all the apples here, so to speak, on the cost of goods sold and against all the professional revenue and optical. So it would be better if you split this out, but it's just cost prohibitive. But in general, most practices are around, very few are below 20%, and then very few are up in this rate at 30. So if you're around 25%, you're doing pretty well. So I'll discuss how that's important also. So the next category is human resource costs. So these are just staff costs, not doctor costs. So having all your HR costs for staff, overtime, anything, healthcare, retirement, everything under your staff HR costs. So then you can see, okay, this is one of the major categories, of course, next to cost of goods sold is typically the most expensive part of your businesses, and I guess it's getting more expensive. So 20%, so this percentage here relates to this column here, not to 2022. So 248,000 of the 1.2 million has been spent or paid on HR costs. So that's a good number to know. If you get up in the 30%, it could be an issue of maybe you're overstaffed, or given your production levels of 1.2 million, if you're up in the 30% range, perhaps you need to have some more efficiencies or more training for your staff, and there could be some HR issues that your staff costs are up high. But point being is just have them all in one section so you really know what this percentage is. Is it going up or is it going down? And then marketing is a pretty small section, but we typically do segregate that section out. Typically it's less than 2%. So it's not, most of the marketing ought to be done, in my view, and in Williams Group's view, by you, the physician in the exam room, recommending ophthalmic lenses, letting your patients know that you are open to taking new patients, etc. So, and that's not a hard cost. It's just communication within the exam room or the optical. So the occupancy is also, it's typically it's usually kind of tied, so to speak, with overhead. These percentages are low, but most occupancy costs cost you 8 cents on the dollar of what you bring in. This is 6.45, but it's just good to know. But this is a fixed cost, so the more your production goes up, the lower this number is going to be. So the more production you can do within your occupancy, your rent, or if you own the building, whatever. So knowing what this is useful, because if you're up in California, you might be spending 15%, or New York, 12 or 13, but just knowing what your occupancy cost is important. And then of course overhead. So normally this is around 8 or 9%. If you get up into 12, 13%, then it gets a little expensive. So if you're outsourcing your billing, that could get more expensive, or if you're running a lot of personal expenses through your office expenses. And I'll touch on that briefly right now. We want to keep anything that's not strictly related to the clinic down here, so down in discretionary, because I'll start talking about the importance of your net operating income. Because this number here, say 37%, if it's 30 or 40, this is the amount of money you've got to spend, essentially. This is how much cash flow that your operations are producing. So the rules of thumb are anywhere between 30% at the low end to 40%. We've seen higher than 40%, meaning that every dollar of production that comes in, you're keeping essentially 40% of it. And then I'll ignore the other income, because these would be things like PPP income, or not income that's not related to your actual operation, seeing patients and your retail side of what you do. So of this operating costs here, or operating income, then you're going to spend it on a few different things. One is your capital costs or equipment. And debt service is typically the same, because you've got lease expenses, that sort of thing. So that's what's going out here. So that's all coming out of your operating income. So I've got 37% here, and I've got 5-ish on my capital costs and debt service. And then how much am I paying my associate doctors? And so this is the unique thing about optometry, in that if we look at the Amazon financial statements, their profit and loss statement, they're not going to split out doctor compensation down here below your operating income, because it's really part of the operations. However, because owner doctors, and these are private companies, you don't have to disclose what your income is like you do like in officers or CEOs of public companies. You can take out compensation based on, for tax reasons, you can take it out just for distributions or in salary, or you can take out a lot because you want to borrow some money, get a home or something, and you want your wages to be high. So it really, it's too flexible of a number to really say, okay, what should it be? Because there's no should, essentially. But I will touch on that in a moment. There is a should in a sense, but we'll talk about that. So that's kind of a summary of how to structure your financial statements. So that you always know what your net operating income is, because that's really the money you've got to spend. You can invest in equipment. So debt service is kind of equipment in that sense. And then you can pay your doctors. So your doctor pay comes out of this. So if you're paying your doctor, say for example 30%, and you've got 5% going out to for capital expenditures, really you've got no return at the end of the day. And I'll talk about that in a second with how private equity kind of looks at this. And it's really important too. That's why we've got this non-operating or discretionary cost. We'll just make this a little bigger, because if you're spending a lot of X dollars on things that, like say travel, you're going to the Bahamas, or you're going to Hawaii, or you're going somewhere for your CE, or you've got office expenses that you don't really need, you're taking some stuff home, whatever the case may be. So, if everything is buried up in here, or just this big laundry list, you can't really see how your actual business is doing. So it's really important just to keep the categories distinct, so that you can see how your actual how efficiently you're operating. So that's kind of the categories. So and this will become a little bit more clear when I show you the operating net here, or what EBITDA is. So just keep in mind this 457,000 of operating net. Well, it's getting I'm 30 minutes in here, but we'll be quick. So 457,000 of operating income at 37%. That's pretty good, actually. So this is how private equity looks at it, and anyone that would want to potentially buy your business at some point, if you're going to sell, and this is one of the reasons why it's important not to put your wages or doctor compensation into this operating net number, because you can make this reasonable comp, you can make the compensation number anything you want. So this is how private equity looks at it. So they take your operating net just like we have it there. So as long as it's clean, because you want this number to be as high as possible. So this is your operating net. Then you take a reasonable compensation off of this 457 for the production or for your doctor compensation. So I've got this production at 17%. So if we toggle that over here really quick. So your top line is 1.2 million. So I'm taking 17% of the production. So that's pretty common as to what private equity is going to pay doctors. You could have it down as low as 15%. But so that's, if you want to know what your EBITDA is, just take your operating net and take 17%, which I've done here, of your collected receipts, and so to subtract that from your operating net. So then your EBITDA is $249,000. So that's the income that your clinic would be producing year over year, but it is excluding any capital costs. So the private equity knows, okay, they've got to invest in equipment, they got to pay taxes. So again, earnings before interest. So interest is just the interest component on capital costs, and then taxes. They know they've got to pay the taxes. They understand that. So that's EBITDA. So pretty simple as to what it is. And then you can multiply that by whatever you think you might be able to get, or from private equity. So I put 7.5, a factor of 7.5. And that's pretty reasonable. Some clinics have been selling at 10 EBITDA. So we got 1.8 million practice value. But if you're going to sell to a colleague, they're not going to pay 7.5 because if you own 500 clinics versus one clinic, it's a way riskier situation if you have one clinic. So that's essentially why private equity can pay a lot more. Plus, they've got better deals because they got more volume with the insurance payers, with the labs. So even though your EBITDA would be this number, after they get all their deals in place, their EBITDA might be 300,000 or so, 350. So that's why they're willing to negotiate on the multiple. So that's the definition of optometry operating net and why it's so important to see it being between 30 and 40%, and having your book structured so you can see your P&L, so you can see what or how efficiently your clinic is performing, and then having them categorized in those 5 categories: cost of goods sold, staff costs, occupancy costs, overhead, and then marketing. After you deduct all those things from your income, that gives you your optometry operating net. Then I would take a reasonable compensation at 17% really to get to what your cash flow is. And then this is kind of extra, the 249 that is recurring over the years. Okay, so that's kind of it. So I covered all 3 of these, and I sort of showed you QuickBooks Online. This is what it looks like. I absolutely love it. It's great. Some people are apprehensive about moving from desktop to QuickBooks Online, but I highly recommend it. QuickBooks Online or Intuit is really promoting QuickBooks Online. It's not as difficult from going to, say, Infinity's EHR to, say, Revolution or CompuLink. Switching EHRs is a lot more cumbersome. But it's also a function of age, I think. As the older we get, the less interest we are of learning to do something different on. It's just in general, especially with computers. But so it does take some getting used to. But there's just so many great reporting functionality that you can get on the online version. Plus, you can see it from whatever device you're on, or on your phone. So I'm a big proponent of. Alrighty, that was your optometry financial statement presentation 101 or 102, maybe 202. So if you have